Good day, fellow investors. If the Activision merger goes through, you make 20%, which is much better than where the market is heading. So 20% plus or 20-30% down, it looks like the Microsoft Activision merger might be a good deal. Let's discuss. So if Microsoft, that has the money, has the billions, manages to buy Activision for $95 per share, compared to the current stock price, you make 77 to 95 minus taxes. That's a great return of actually 23%. So I've made this video discussing Warren Buffett's investments, and he is now a huge investor in Activision for the merger arbitrage deal. If we check Warren Buffett's portfolio here on Stock Circle, formerly Cheaper Than Guru, so you can see here the position of Activision, and you can see here there was a small purchase in 2021, but now he tripled it now at a higher price, given the merger arbitrage opportunity, to make 15, perhaps for him, a little bit more now as the stock price goes down, 23% when Microsoft actually takes it over. So there are two things to keep in mind here. Is, okay, if it happens, you get 23%, likely next year, June, if all things go expected. And the second thing is, if it doesn't happen, then you become a proud owner of Activision. And that's what I want to discuss in this video. Also, make a valuation and explain the risk and reward of this merger arbitrage play. Perhaps it is a value investment win-win situation, and if you like win-win situations when it comes to investing, merger arbitrage that like button to support the channel, and consider subscribing if you haven't, and hit that notification bell so that you see when I make a video that might add value to you. Thank you very much. Let's first discuss what is merger arbitrage. This is a very simple one, but there are more complex ones. If you look at Investopedia, merger arbitrage, you go long the acquired company, you go short the acquirer, and that's a little bit more complex, not really for retail investors, mostly for hedge funds. Then they get the shares of, in this case, Microsoft, and they are short Microsoft, so they cover that, so no risk there. But this is now not this complex. This is just a simple merger where you buy here hoping that Microsoft will pay $20 more or $18 more, and you make the $18. Also, Microsoft is a little bit too big to having the merger not going through or going through, impacting it. With a market cap of $2 trillion, it doesn't really matter if they don't spend the $60 billion on Activision or not. So the current return there is 23% if it goes through, and that's not bad, especially in the current market environment. But why it is so? Why is there the 23% opportunity? Well, first, it doesn't happen immediately. The deal is expected to close next year. So we have 1 year for 23%. That's still not bad. But there is the risk that it doesn't go through. And here it comes to investing, and you say, okay, am I a happy owner at this price if the deal doesn't go through? If you are a happy owner of Activision, and we'll make a valuation for that soon, then it is a good buy for you. So win, and owning a good business at a fair price if it doesn't go through. And perhaps we'll discuss in a moment, there will be other buyers if Microsoft is not allowed to buy. And found this articles, how could the Microsoft Activision deal fail, from Bloomberg. So they see that FTC chair Lina Khan is against these big tech mergers, and saying how she blocked Nvidia and ARM, Lockheed, and Aerojet Rocketdyne, so really going against these platforms, and of course against Microsoft. So we'll see whether she will win, but then they will get legal retaliation from Microsoft. It's a lot of money, and we don't know whether FTC has the power to deal with such a big player. And the risk is, if it fails, you become an owner of the company. Let's analyze it to see what's the risk and reward. We have to first understand the company, the business, and then look at the financials. What is Activision? This is from the investment page. So they have legendary franchises, World of Warcraft, Minecraft, Call of Duty, Candy Crush. I've never heard of this aspect of this. I maybe played it when I was 13, that's 25 years ago. Was it that one with AI Sir, AI Captain, or that was Age of Empires? I don't know anymore. But anyway, I'm sure many of you are familiar with these. However, the last quarter results were a little bit down. So revenue down, what's that, 20%. Earnings per share down a little bit. Of course, when we were all stuck at home, many played games, so revenues were higher. And if we look at their strategy, they want to sell more, increase the sales price per user, make more, so they are likely to be doing that over time, update their pipeline. So 119 million users over the third quarter. That's really good. And if we look at the quarter, the earnings, so a little bit down, but the trend should be upward long term. And they have a great balance sheet, 10 billion in cash, so net cash 7 billion, so good operating cash flows, really good, very high margins, which means it is a good business. So good margins, great business, very interesting position. Let's look a little bit deeper at the financials. So if we look at revenues, growing over time, doubled over the last 10 years, so nothing wrong there, just a slowdown recently, but that's survivable. Extremely high margin, so they make a lot of money, and of course the more they sell, the cost is fixed, pretty fixed, which increases operating income and of course net income, which over the last years I would say an average of 2 billion, leading into, let's say, earnings per share, of course higher due to the pandemic, but let's say $3 going forward to be conservative estimation. There is also a dividend, and the cash flows are just a little bit shy of earnings, so it's okay if I use earnings per share for valuation. So let's go to our comparative table for valuation. So you can download this one in the link in the description below, change the inputs, and also check many other stocks that we have analyzed here on YouTube. So I have left it open. I've said earnings per share. Let's say that they make $3 per share and that they grow at 8%, which is the expected growth for the market. So I found this from Statista. For the next 4 or 5 years, the expected growth for the market is 8%. Of course, they can do better, they can do worse, but they will acquire others, etc. So likely that given their size, they might grow in line with the market, and of course not as fast as they did previously, but still the market is there for growth. Back to valuation, if they grow 8% per year, if I expect a 10% return from my investment, and they have just a 15 P/E ratio 10 years down the road, which is a good P/E ratio, and then here I have to change the present value of these earnings because most of these earnings are invested for growth. Therefore, I cannot calculate the present value of those as it would be the case if those were distributed to me. So as the dividend is, what is this, 16% of earnings, I multiply the present value here with 0.16, and now I have a better explanation of present value from the present value of the dividend there. And now the intrinsic value for a 10% return with a conservative terminal multiple is 39, so plenty of downside to make it a great investment. Of course, Buffett likes it, but he likes a lot of things these days. If I am more exuberant, if I put 12% growth ahead, a terminal multiple of 25 for such a company, adjust this, then we are at a fair value if the company grows at that speed. So we are then also for what Microsoft is paying, so Microsoft is happy with these returns, and maybe they can grow that with Microsoft. So let's make also this final one, 4% growth, let's say slower, again times 0.16, pull it across, and we have just 20 in a negative case scenario. So risk reward 44, which is still significant downside from my investing perspective. And now let's also make this for the market cap, the market price. So Activision, and compare to the 10% return that we have found, so we can see that it is pretty expensive in line with a lot of other things, but then again there is other. Maybe there will be other buyers. So Bloomberg says that the company has put itself for sale, which always tells you, okay, if Microsoft fails, maybe some other company will be interested, and then they will know what the FTC said that was not okay, so they will understand it, and therefore there will be no objections to the purchase. Also, if we look at the stock price, it was also much higher before the intervention for Microsoft, but also much lower. So the P ratio here is 24, the dividend is not that big, but if you believe in the company, you might say, okay, I buy it now, and then if it fails, I buy more of it here, and then average down, and then sell when it again gets good news or someone manages to buy it, etc. So you have to see how this fits your portfolio strategy. So it looks interesting, but the downside for me is not an absolute value investment with a margin of safety. Therefore, it is not for me, despite the 20% potential gain over next year. If you enjoyed this, if you enjoy value investing, smash that like button, and I'll see you in the next video.